Good afternoon, everyone, or good morning, depending on where you're joining us from, and welcome to today's webinar. My name is Kate Chalker, and I'm a senior solicitor with the firm, working out of our Sydney office. Today's presenter, we have Kimberley Barnes, who is also a senior solicitor with the firm. Kim works out of our Brisbane office, but she does a lot of work with the Sydney team, and I'm sure many of you have either dealt with Kim before or seen her present one of our webinars. So in the last webinar that we presented, I took you through a very high-level summary of the estate administration process, and I very briefly touched on a couple of the different taxation aspects that can arise during that process. In today's webinar, Kim will be taking a much deeper dive into those taxation aspects and work through the different considerations throughout the administration process. So just a couple of housekeeping matters before we get started. The PowerPoint slides from today's presentation are available for download. All you need to do is click on the Files tab on the right-hand side of the screen, and you'll be able to download a PDF version from there. But if there is any issue with the download link or you can't seem to figure it out, don't stress, because they will be included in the feedback email, which will be circulated sometime later today. Also, if you could just keep an eye out for that email and take a couple of minutes out of your day to complete that survey, that would be fantastic. Also, if you do have any questions which arise throughout the webinar, feel free to send them through. All you need to do is to click on the chat button, again on the right-hand side of the screen. I'll be monitoring those questions and I will interrupt Kim at an appropriate time to put those questions to her. Also, just keep in mind that today's webinar is being recorded and will be made available on our website and also on our YouTube page at a later stage. So just keep in mind not to disclose anything confidential in your questions. All right, so without any further ado, I will hand over to Kim to get started on today's webinar.
Thanks, Kate. So as Kate said, I'm talking about some of the tax aspects that an executor might face when dealing with estate administration and the differing beneficiaries under an estate. So as an executor, you are the person who's dealing with impatient beneficiaries and various other third parties during that administration process. But what does that role actually entail, and what tax issues should an executor be aware of? Acting as an executor isn't without its complications and challenges. There are varying different time limits that must be adhered to and complex tax matters that must be considered while you're sitting there trying to juggle the various beneficiaries' personality and quite often them saying, well, where's my money? When can I get my money? So this session today is going to address and focus on the tax aspects of the estate administration. It's going to try and provide an understanding of the process, what time limits an executor might want to consider, and any tax implications that might exist along the way. So specifically, we're going to have a look at the roles in a deceased estate, because it's quite important to understand what they are, the time limits an executor should adhere to or at least be aware of, an ATO checklist which they put out when you are an executor, how you actually go about accessing the deceased affairs, particularly in relation to superannuation and any outstanding tax obligations. We're going to have a look at a couple of ATO rulings, practical guidances, the executor's obligations, and some examples of tax liabilities, particularly in a sense of foreign beneficiaries and dealing with superannuation proceeds. So firstly, in a deceased estate, there are a large number of those personalities involved. So we have the testator, who's the deceased or the writer of the will. And then the executor. This person's been appointed by the testator in order to carry out the terms of the will. The trustee, which is often a term interchangeably used with executor, isn't actually factually correct. Whilst an executor and trustee are generally the same person, the two roles aren't the same. And finally, we have the beneficiaries, and they're the persons who are going to receive the assets from the estate. So an executor's role is to collect the testator's assets and pay out all of the liabilities of the testator. Once all of those assets have been collected into the estate and all the liabilities have been paid out, the executor role shifts to that of a trustee. And so the trustee will then hold those assets on trust until they're distributed to the beneficiaries under the will. However, for income tax purposes, the Commissioner treats the estate and the trustee as one and the same. Where no person has been appointed as an executor or there's no surviving or willing to act executors, the court may appoint a person in this role. However, they will be referred to as an administrator and not an executor. A beneficiary under the will has no role or obligation to play in the administration of the estate, but they do have a beneficial right to ensure that the estate is properly administered. So time limits. So if we have a look at one of the time limits, and that's to do with the tax rate. Generally, we know that a trustee who's assessed on the net income of the trust will pay tax at the top marginal tax rate. However, a trustee or executor who lodges a tax return for an estate for the first time can apply for a concessional rate of tax. This concessional rate of tax is the same as an individual's tax rate, meaning that the estate can access the full tax-free threshold of $18,200. However, there are strict time limits imposed on accessing this concessional rate of tax, and this concessional rate will only apply for the first 3 income years of the estate, unless there's been material changes to the estate's circumstances. The trustee does not receive any income tax offsets, and there is no requirement to pay the Medicare levy surcharge. Importantly, this concessional rate of tax cannot be extended beyond that 3 years. Upon the 4th income year, more onerous tax rates will apply, and importantly, the tax-free threshold will no longer be available. So the use of this concessional tax rate during the first 3 years of the administration of the estate can ultimately minimise large tax burdens that might not exist if but for that concession. Therefore, a trustee should really pay close attention to this 3-year period and try to ensure that the estate has been administered prior to that 3 years elapsing. Another time limit that's quite relevant for an executor is the time limit in respect of the CGT main residence exemption for the principal place of residence. So ordinarily, the CGT main residence exemption is available on a sale of the deceased's main residence by the executor or beneficiary, provided that they cease to own the property within 2 years from date of death. As the phrase ownership interest ends is used, critically, the residence must have been sold by and completed within the 2 years. It's not enough to just have executed a contract for sale. So here we have, it needs to have settled. It can't have just been a signed contract. However, Section 118-195 of the 97 Act, the Commissioner does have the discretion to allow a longer period to sell the main residence of the deceased. And under that, he has released, or the Commissioner has released, the Practical Guidance Compliance Guideline 2019-5EC. And this outlines when they will generally allow a longer period, and it also provides a safe harbour approach that allows executors to self-assess on that discretion. So under that safe harbour, how does that affect the time limits? So an executor can treat the Commissioner's discretion as being granted, provided each of the following conditions are met. So 1, during the 2-year post-death period, more than 12 months was spent addressing one of the following issues. So ownership of the property under the will was being challenged. So that might be in circumstances where someone says, no, that's my asset, and the executor's been dealing with that. A life or other equitable interest was created by the will and therefore delayed disposal of the asset. So that will be where the testator has left a life interest in their main residence, and therefore the property can't be sold until that has extinguished. Or settlement was delayed or fell through due to circumstances outside of the executor's control. Secondly, the property was listed for sale as soon as practicable after the relevant circumstances were resolved, and that sale was actively managed through to completion. The sale was settled within 12 months of listing. So fourthly, we've got the following circumstances were immaterial to the delay. So that could be waiting for the property market to improve, that the executor was doing refurbishment or repairs on the property, it was just inconvenient to arrange the sale, or there's some kind of unexplained inactivity by the executor. So even if any one of those top things apply, if one of those reasons was caused the delay, the safe harbour approach can't be relied upon. And finally, that additional period for the discretion to be granted can't exceed 18 months. If an executor is wanting to rely on this safe harbour, they should retain records to explain the delay. That way, if there ever was a question or an audit, that those records are there ready to show why. To sum that all up, an executor is able to rely on the main residence exemption on the deceased, provided that the property was sold within 2 years from date of death, or within 3 years and 6 months if they're relying on those safe harbour provisions. The use of that main residence exemption can save the estate or the beneficiaries substantial tax costs. So an executor should be really paying attention to these timelines and trying to complete any sale before that 2-year expiry, or if they can rely on the safe harbour before the expiry of that. So outside of the safe harbour approach, the Commissioner still does have discretion to allow further time to sell that main residence of the deceased. However, this is usually done, or has to be done, in the form of a private ruling. So generally, the Commissioner will still exercise their discretion where the property couldn't be sold due to reasons beyond the executor's control, and those reasons existed for a significant part of that 2-year period. So the ATO has released, I think it's a 12-step checklist of what to do when a person has passed away. 10 steps it has, not 12. A few of the earlier ones are sort of just look after yourself and pause all tax correspondence. It talks about, determine who's actually supposed to manage the deceased affairs and the deceased estate. Again, get help if you need it. Look at whether you need a grant of probate. Make sure you notify the tax office that you're managing the affairs of the deceased. Make sure that you're managing any business tax obligations, so that could be your VAT statements. Make sure you lodge the final tax return, lodge any other outstanding tax returns, and make sure that the deceased tax returns and tax affairs are all finalised. The checklist can be a useful tool for executors to ensure that they're meeting all their tax obligations of both the deceased and the deceased estate. But importantly to note from all that is an executor should ensure that all tax returns, business activity statements, and other taxes are paid by the deceased estate, and ensure that all obligations of the executor, which we'll discuss further below, are all met. So one of the things you do have to deal with when you're an executor is accessing the deceased tax affairs and their superannuation. So a legal personal representative should contact a deceased person's superannuation fund, or funds if they do have multiple, and the Australian Taxation Office to let them know of the deceased's death. And they need to request information concerning the release of any superannuation funds that they might hold. So a person who is the authorised legal personal representative, and we'll discuss what that means shortly, can access a deceased person's taxation and superannuation information. So for tax purposes, the authorised legal personal representative does mean the executor who was nominated under the will once probate has been granted by the court, or if they're an administrator, if letters of administration have been granted. If probate hasn't been received and it's not applied for, the person is not an authorised legal personal representative, and restriction is placed on them as to what tax and superannuation information they can receive and can be provided. If a person is the authorised legal personal representative of an estate, the Australian Taxation Office can give the person a data package of tax and super information for the last 3 years. And generally, this data package is going to contain things in relation to the tax information for the last 3 financial years, an extract of income and investment data that they have for the last 3 years, notices of assessment for the last 3 years, the most recent statement of account, any outstanding debt, and any information in relation to their superannuation funds, and finally, any payroll data that they have for the current year. So then we have a look at tax obligations under IT 2622. So this talks about the different tax obligations that are placed on the executor, but specifically deals with present entitlement during the stages of administration of deceased estates. So this considers the income tax liabilities of executors or administrators and beneficiaries of an estate during that estate administration process. On the death of the taxpayer being the deceased, the property of the deceased person passes to their estate and legal control over these assets is exercised by the executor or administrator. The executor or administrator effectively steps into the shoes of the deceased and they must wind up this person's personal affairs. So as we've sort of briefly mentioned, the executor must call up the deceased assets and liabilities, pay the debts, funeral expenses, and any other testamentary expenses. Once all those matters have been attended to, the executor distributes the property of the deceased to the beneficiary of the estate or beneficiaries. And there is a fiduciary obligation assumed by the executor in favour of the beneficiaries. But the question we ask ourselves is, what happens to income generated by the deceased assets and estate? And that's what this IT 2622 deals with. So in a deceased estate, whether a beneficiary is presently entitled to a share of the income of the trust estate for the purposes of Division 6 of Part 3 of the 36 Act depends on 3 things. One being the stage reached in the administration of the estate, the terms of the deceased will or codicil, trust law and principles enunciated, and the orders that the court may make. And 3, whether any discretionary payments have been made by the beneficiary to the beneficiary by the executor or trustee. So Division 6 requires that the net income of the estate is ascertained in the principles in subsection 95(1) of the 36 Act, and the net income of the trust, or the estate as the case may be, is then assessed to the beneficiary or trustee depending on whether the beneficiary is presently entitled to the income of the trust estate or is under a legal disability. So the Commissioner has 3 relevant periods of administration, which is used in determining whether a beneficiary is presently entitled to the income or if it's the trustee. So firstly, we have the initial stage, and this initial stage of administration is where the net income of the estate is still applied to reduce debts and pay out liabilities. We've got 2, then the intermediate stage, and that is where part of the net income of the estate that's not required to pay out debts may be paid to beneficiaries. And then the final stage where debts, etc., have all been paid out and provided in full, and the net income of the estate is available for distribution. So if we continue on to beneficially entitled, and what that means is a beneficiary of an estate cannot enjoy present entitlement to income derived from an estate during the administration process. Any income that is generated in the income years before the administration of the estate is complete is the income of the executors or administrators and not the beneficiaries. So this position comes from a leading Australian case of present entitlement under a trust arising during the course of administration of the estate, being the Commissioner and Whiting. So the High Court held that a beneficiary of an estate cannot be presently entitled to the income of the estate until the estate has been fully administered, and that's when all the assets have been called in and all the debts have been paid out. So if we briefly have a look at the 3 stages, so during the initial stage of the administration, the beneficiaries are not presently entitled to the income of the estate, and so therefore the executor is assessed on the net income generated by the estate. Obviously, if it's in the first 3 years, it'll be under those concessional rates of tax. In the intermediate stage, the executor might find that there is a point in the administration of the estate that the net income or part of the net income is not needed or required to pay for debts of the estate. So in these circumstances, the executor may pay or apply the benefit of the net income of the estate to the beneficiaries under the will. It's in these circumstances the beneficiary will be presently entitled to the net income to the extent of the amounts that are actually paid to them or paid on their behalf. The fact that a estate hasn't been fully administered doesn't prevent them from being presently entitled to income that they've actually received or that has been paid on behalf of them. So if we look at the final stage, and this occurs once the residue of the estate has been ascertained, this is then the estate has been fully administered. The estate doesn't necessarily need to be wound up, just the residue of the estate is known. So at this point, the residue beneficiaries are presently entitled to the income derived by the estate. As I said, the administration of the estate doesn't have to be wound up for the beneficiaries to be presently entitled. So once all those debts have been provided for and any specific gifts or legacies have been provided for as well, the residue of the estate can be ascertained with certainty, and it's at that point the administration of the estate is complete, not necessarily when it's all being wound up. So if an estate has been administered and completed during an income year, it's the commissioner's position to raise assessments on the basis that the beneficiaries who aren't under a legal disability should bear tax under Section 97 of the 36 Act, and they will be assessed and taxed on their share of the net income of the estate. If a beneficiary is under a legal disability, then the estate would be assessed in the manner required under Section 98 of the 36 Act. So what this means is, if a beneficiary is presently entitled to the net income of the estate on the last day of the financial year, the beneficiary will be assessed on the income of the trust estate for the whole income year. So notwithstanding the above, it is the Commissioner's practice to accept an apportionment of income in the income year the estate is fully administered. But this can only occur in circumstances where the executor can demonstrate by striking through the accounts at completion of the administration actual amounts that were derived in the periods before and after the day the estate was fully administered. So in these circumstances, income derived in the period between the beginning of the income year and in the day the administration was complete can be assessed under the hands of the executor under Section 99 of the 36 Act. And secondly, income derived the day after the administration was completed to the end of the income year can be assessed by the beneficiary's present entitlement to the income in the manner required by Section 97 or 98 of the 36 Act. There must be evidence of the income derived during these periods and the apportionment of net income. So what that means is you actually have to ascertain what income was derived when and from what assets. You couldn't say that, half of the income was derived and then half was derived afterwards. It has to be actual known income, not just like a 50-50 split or 25-75. It has to be actual income.
While you're having a drink of water, Kim, I might just jump in with some questions if you don't mind.
Mm-hmm.
All right, the first one we have, if in a particular income year, we'll call it year one, a person dies, will there need to be two separate tax returns filed? That is, one from 1 July to the date of the person's death, and then another tax return from death to the end of that income year.
Yeah, there will be two tax returns, and Kate have explained it. It's exactly how it's going to occur. So up until the deceased passed away, there will be a tax return up until that point. And then after the death, there'll be a tax return starting from that date until the financial year's end close. So yes, there will be two tax returns.
Thanks, Kim. Second question. If the beneficiary of an estate is a foreign resident for tax purposes, will the trustee still be entitled to the concessional tax rate?
There's no reason they shouldn't be. I would have to have a look in that a bit more detail. I am discussing foreign residents at the end of this, but I can't see why they wouldn't get the concessional rate of tax.
All right, the next question we have, what happens to the main residence exemption if there is a life tenancy granted?
So the main residence exemption, we have to go back and look at, well, what happens when that asset moves into the beneficiary's or the executor's name. So what I think it's 118-110, where you've got the table of, you receive market value for the assets. Now, generally what will happen there is, depending on how the asset is transferred, both the beneficiaries, if it's in their name, and the life interest is registered on title, there'll be a split of the cost base of the asset based on that market value. So the principal place of residence exemption will pass through, but it'll give them a market value cost base. I'm assuming that the person who's received the life tenancy is going to be the spouse and living in it, which means if they extinguish that life tenancy early, they should still be able to access the main residence exemption. But then it's about thinking, well, what happens if that property is subsequently sold? Likely it's going to extend beyond the safe harbour provisions, which means that if the beneficiary wanted to sell it after that life tenancy has been extinguished, they'd need to apply to the Commissioner for a private ruling for an extension of that concession to continue to grant the main residence exemption.
Thanks, Kim. Just two more at this stage. Let's say we have a testator who left behind a discretionary trust which had some assets. The discretionary trust is an Australian tax resident. However, all of the beneficiaries of the estate are foreign persons. How will the executor get the funds out of the trust and distribute them? And what could be the potential tax effects of making those distributions to foreign persons?
Well, one thing to really consider here is assets in a discretionary trust do not fall into a person's personal estate. It's quite a nuanced question, and it's going to really need to consider, well, who's taking control of that trust? If they're a foreign person, well, what's going to happen to those assets, assuming that they're all Australian taxable property, whether they're dividends or not? You then have to consider, well, which country they are in and any double taxation treaties that we might have, whether there's foreign inheritance tax. But like I said, discretionary trusts aren't personal assets. It's a very nuanced question, and it needs a lot of understanding of the circumstances of the trust, assets and beneficiaries to really answer in detail.
Thanks, Kim. And last one for now. Under what circumstances would probate not be required?
So this really just comes down to the fact that in Queensland, you don't need to get probate to deal with certain assets. I know most states, including New South Wales, you have to get probate regardless. So really it's just referring to Queensland. And in Queensland, you might not get it if you don't have substantial assets. Banks in Queensland usually only need probate to deal with money that's over $50,000. Our Titles Department also allows you to transfer sort of one property without probate and just a copy of the will. So it's really just in Queensland. No other state is really relevant.
Thanks, Kim. We've had one more come through, but we can probably deal with that one at the end.
All right, beautiful. Well, I will continue on sole trader and the obligations of the executor if the deceased was a sole trader. So a sole trader refers to an individual who operates a business under their own name. They are personally liable for all obligations and liabilities of a business, and all income that's generated by the business is their personal income. So a death of a sole trader can have ramifications as the business has technically concluded because they're no longer alive. If the legal personal representative continues the deceased business, they should be applying for their ABN, as that existing ABN can't be used. A legal personal representative should ensure that all final business activity statements for the last tax period is lodged. And that's usually done in the quarter in which the deceased died and ends the day before their death. They also need to lodge any outstanding business activity statements and make sure that they pay any outstanding tax liabilities. So if during the administration of the estate business assets are sold, consideration would also need to be given to any GST, capital gains and income tax consequences that might arise from the sale of a business or sale of business assets. and they may wish to consider whether they can access any small business concessions and whether they might apply on the business asset sale as well. There is that 2-year time limit period as in accessing small business concessions as well, very similar to that of the main residence exemption. So then if we have a look, well, what happens if the deceased was involved in a partnership? So where a person dies and they were in a partner in a partnership, what happens to that partnership is going to depend on whether a partnership agreement existed. If no partnership agreement exists, then what happens to the partnership is going to depend on the relevant state and territory's laws. And most legislation says that upon the death of the partner, the partnership ceases. The Commissioner will allow a two-party partnership to be reconstituted where the partner dies, and the partnership agreement allows the continuity of the partnership with the executor, trustee, or beneficiary of the deceased estate. That's why a partnership agreement is really important. If clients don't have one, they should consider getting one, because without that partnership agreement giving them that power, that partnership is going to cease. So if a partnership has dissolved due to the death of one of the partners, final tax returns and business activity statements do need to be lodged as well, and amongst other administrative tasks by the executor in relation to winding up that partnership. As each partner is jointly and severally liable for all debts, this does include all taxation liabilities, care needs to be taken in winding up and dissolving the partnership assets. And again, we're going to need to consider GST and tax consequences, access to the small business CGT concessions on that wind up. So basically, a legal personal representative, executor, administrator should first look to the partnership agreement to determine the best course of action when dealing with partnership assets and any possible tax implications post-death. Now, one thing executors are generally worried about is, well, when can they be personally liable for the deceased taxation affairs? So an executor can become personally liable for tax debts of the deceased in the event that the distribution of the estate occurs with notice of a claim by the Australian Taxation Office. So Practical Compliance Guideline 2018-4, income tax liability of a legal personal representative of a deceased person, provides this guidance on when an executor will be treated as having notice of a claim by the Commissioner, including a claim arising by way of amended assessment. So this PCG doesn't deal with any liabilities that an executor may have in relation to the deceased estates after the period of the deceased death. This is only for periods before the deceased death, so effectively outstanding tax returns. Who does this PCG apply to? So this guideline applies to a legal personal representative who has obtained probates or letters of administration of the deceased, provided that in the 4 years prior to the deceased person's death, they did not carry on a business, they weren't assessed on the share of the net income of discretionary trust, and they weren't a member of a self-managed superannuation fund. Also, the estate can only consist of public company shares or other interest in widely held entities, death benefit superannuation proceeds, Australian real property, and cash and personal assets such as cars and jewellery. And thirdly, the total market value of the estate assets at the date of death was less than $5 million, and none of the estate assets are intended to pass to a foreign resident, tax-exempt entity, or a compliant superannuation entity. So this guideline doesn't apply to persons who have not obtained probate or letters of administration, as in these cases, a legal personal representative cannot be held personally liable for a deceased's outstanding liabilities. However, there is a different collection mechanism under the Tax Administration Act that allows this to be recouped. But again, that's generally only going to apply in Queensland. So notice of a claim, we have this, notice of a claim. What does it mean? Well, the Commissioner provides that it is a question of fact whether a legal representative has had notice of a claim by the Commissioner, but the Commissioner considers the following circumstances as having notice of a claim. 1, any amounts owing to the Commissioner at the time of death, including interest charges. Liabilities arising from the assessment of income tax returns that the deceased has lodged but have not yet issued. Liabilities arising from assessments relating to any outstanding tax returns, and that's because the legal personal representative is required by law to lodge these. And where the Commissioner has decided to review or examine the affairs of the deceased estate, it will notify the legal personal representative. And if the legal personal representative has notice of those liabilities, notice of that audit or review, and then they will be deemed to have notice of any liabilities that arise from that review. So instances where no notice of claim is given, so the Commissioner will treat legal personal representatives as not having notice of a claim in the following circumstances. 1 being tax returns are lodged or were advised that not necessary by the legal personal representative, where they acted reasonably in lodging all those outstanding tax returns, and the Commissioner hasn't given the legal personal representative notice that it intends to examine the deceased taxation affairs within 6 months from the lodgement date or advice of the non-lodgement. 2, where the legal personal representative becoming aware or should reasonably have been aware of a material irregularity in the income tax return lodged by the deceased, where they have brought it to the Commissioner's attention in writing, for example, by requesting an amendment, and the Commissioner does not within 6 months issue an amended assessment or indicate that they intend to review the matter. So what happens if the executor has discovered further assets? So if further assets come into the hands of a legal personal representative after it believes it has finalised the administration of the estate, the legal personal representative must reconsider the deceased person's tax position. The identification of further assets may suggest that the deceased taxable income was understated previously, and in these circumstances, the Commissioner will treat the legal personal representative as having notice by a claim of the Commissioner to the extent of the amount of those further assets identified. So there is an example provided that the Commissioner will seek to recover tax-related liabilities from the legal personal representative up to the value of those further assets identified. So for example, if the executor found a parcel of shares and they were worth $500,000, if there was a tax debt associated with those further assets of $500,000, they could recover the whole amount, but not an amount if it was $600,000 because it's up to the assets identified. So what are some of the key takeaways from this practical compliance guideline? They can only be relied upon in circumstances where the deceased estate is relatively small and simple, less than $5 million. A legal personal representative may wish to consider delaying administration of the estate until 6 months elapses from the date of lodgement of the deceased tax return and outstanding tax returns, and that's to avoid any personal liability. For large and complex estates, the legal personal representative can't rely on these guidelines, and they should take care, they should always take care, but in finalising the administration of the estate, particularly where complex tax circumstances are involved in those previous years. It has been acknowledged by the Commissioner that distribution of estate assets are sometimes delayed until the relevant review period has expired for the deceased, whether that might be 2 or 4 years from the date of an assessment. And that's to try and ensure that the legal personal representative doesn't have to satisfy personally any tax liabilities. There is concerns from practitioners of the lack of guidelines in relation to larger estates. It has been raised, and the Commissioner hasn't expanded yet or reviewed the operations of these guidelines to try and capture more estates. So now we're just going to look at 2 examples of tax liabilities that an executor may need to deal with. We're going to look at foreign residence and superannuation benefits. So if a beneficiary is a non-resident, then the trustee shall pay tax on their share of the net income of the estate on their behalf. This is the same approach that occurs for beneficiaries under the 18, bankrupt, or do not have legal capacity. So the estate must pay tax at the non-resident tax rates of a non-resident of Australia. However, no Medicare levy is payable. The legal personal representative should seek advice if their beneficiary is a non-resident to ensure that they're complying with their withholding obligations for tax. So that's important to come back to the question is when they're presently entitled to the income, they will have to withhold tax. But before they're not, like I said, a bit uncertain as to whether they would access the concessional rates of tax, but I don't see why they wouldn't. A legal personal representative who withholds tax for a foreign beneficiary should provide the following information to a non-resident in respect of that income distribution, that being their interest, and that should include their interest in the distribution and the amount of withholding tax paid, unfranked dividends in the distribution, and again, the withholding tax that was paid, and franked dividends and their distribution, and the amount of tax that the estate has paid on their behalf. So if we move on to superannuation benefits, superannuation death benefits and death benefit termination payments received by the estate are considered income to which no beneficiary is presently entitled. So a person who receives a superannuation death benefit may have to pay tax on this amount depending on whether they are a dependent of the deceased under tax law, whether it's paid as a lump sum or income stream, whether the super is tax-free or taxable, and whether the super fund has already paid tax on the taxable component, their age and the age of the deceased person when they died. That's particularly relevant for income streams. So a person who is not dependent on the deceased for superannuation purposes must pay tax on any super death benefit received where there's a tax element at 15% plus Medicare and an untaxed element 30% plus Medicare. However, in circumstances where the legal personal representative receives the funds, the Medicare levy is not payable because there's no beneficiary presently entitled to the income of the trust. So if the super benefit is payable to the estate, the legal personal representative must include the taxable element and the untaxable elements in the deceased estate's trust tax return as assessable income when these amounts are paid to a non-tax dependent. So that's the children generally. And in these circumstances, the legal personal representative must deduct tax before paying the death benefit to the non-dependent beneficiaries. So they'll pay tax on behalf of the beneficiaries and the beneficiaries will receive the remainder. So in circumstances where the trustee of the superannuation fund makes payment of the death benefit directly to the non-dependent beneficiary, the beneficiary must include these amounts in their tax return, and then they will pay Medicare levy on top of it. So sometimes giving your super death benefits to the estate can work out in a bit better of a tax outcome because of that Medicare levy. That is all I was going to talk to you about today. So if there are any questions, we have some time to take a few more.
Thanks, Kim. We have had a few questions come in. I'll just raise the superannuation one while you're on the topic, and I think you may have just answered it. But the question was, what are the taxation implications if the super death benefits are paid by the trustee of the super fund to the residue beneficiaries, being non-financial dependents, compared with paying those benefits to the estate, the legal personal representative, and then distributing them to the residue beneficiaries under the will?
So the main difference is the payment of that Medicare levy. So where it comes directly from the trustee to the beneficiaries, it's included in their assessable income and they'll pay tax, taking into account the 15% that might ordinarily have been paid. Whereas when it goes to the estate, they don't have to pay the Medicare levy and it gets distributed to them already.
All right, thank you. This question's not quite clear to me, but I'll read it out for you anyway. If a property is owned by joint tenants, then the share of the deceased person will be passed to the other person. That's correct. Is the deceased estate trust required for the late person before the property title is updated with the titles office? I'm not quite sure what the question is getting at, but I'll just say that in New South Wales, all you need to produce to the titles office is a notice of death, and also proof of the death of one of the joint tenants, normally in the form of a death certificate. And that's all the titles office need to move the property across to the surviving joint tenant. I assume the position is similar in Queensland, Kim?
Yep, same thing, just a simple form to titles and it records the death. Yeah.
Okay. Next question. Income generated in the deceased estate is taxed at the estate level, and if it's then distributed to beneficiaries, is the income again taxed at the beneficiaries level?
No. So it's one or the other. So either the trustee pays it or the beneficiaries pay it, depending on whether the beneficiaries are presently entitled to that income.
Okay. Paying superannuation death benefits to the beneficiary versus to the estate, is this based on which bank account the funds are paid to, or if it's to an estate bank account which is not set up, can payment to the executor be treated as payment to the estate?
This comes down to what the binding death benefit nomination says, or any nominations that may have been made. If there's a nomination that says it's being paid to the beneficiaries, it's going to go straight to the beneficiaries. If the nomination says it's to be paid to the legal person or representatives, it's going to be paid there. If there's no nomination, it's about writing to the trustee and asking them, here's where I want the money to go.
All right, next question. Again, this one's not really clear to me, but the question was, do you need a trust resolution for distributions to beneficiaries in the estate? I'm not quite sure whether that's referring to a testamentary trust distribution or just assets going from the executor to a beneficiary of the estate. But I suppose, what are the documentary requirements for making those distributions?
It would always be worthwhile having a resolution from the executor distributing distributions to the beneficiaries, particularly where you're in that intermediate stage of administration. And that's because you'd be making the choice to give them income rather than it being assessed to you. So I would definitely have some documentation and records there for that purpose.
All right. Going back to the apportionment, so where you've got income being apportioned between the executor and a beneficiary, can the income be apportioned on an accrual basis? For example, if you have term deposit interest.
It has to be done by striking through the account. So it's really going to have to depend on if you can ascertain what income was made up until that point, and then what income was made after that point. So while a term deposit, you might be able to strike the accounts, it'd be quite difficult, I guess, to pinpoint how much interest had accrued up until that point, and then how much had accrued after that point because of the whole compounding thing. But you guys are the accountants and good with the numbers, so I'm sure you'd be able to work it out.
Okay, next one. If a trust deed allows for an interim distribution, can an interim distribution by resolution be made to the deceased in the period before they pass? I'm a bit confused on that one. We might need to get some clarification from Stuart.
So it looks like you're trying to determine whether a trust can distribute to a deceased person. I wouldn't think you'd be able to make a distribution to the deceased once they've passed away. If an interim distribution was made before they died, that would still stand. But post-death, you wouldn't be able to distribute income to them.
Thanks, Kim. What are the risks of being an executor if the estate happens to be bankrupt?
If an estate is bankrupt, you're going to have to, it's going to be insolvent, and you would have, depending on the estate, somebody appointed to administer the estate. So a trustee in bankruptcy would come in. The risks, realistically, you wouldn't have done anything. You probably put it into that bankruptcy quite quickly. You could renounce before you've got probate, so you're not involved. But obviously there would be some risks there, but the trustee in bankruptcy would undertake and deal with most of those problems.
Thanks, Kim. Next one. Can the executor of an estate distribute untaxed income, for example, unfranked dividends received, to the beneficiaries of an estate and let them declare this income in their personal tax returns?
They would have to declare any income that is distributed to them, whether it's untaxed, unfranked, or otherwise, would need to be included in their tax returns.
Okay, next one. If there is income that has been allocated to beneficiaries as being presently entitled, when should the executor be advising the beneficiaries of the related tax income amounts?
Sorry, I'm just reading the question again.
That's okay.
So the executor wouldn't be able to tell them about the related tax income amounts, particularly where income's being distributed, because it's all going to depend on their marginal tax rates. The beneficiary would just need to know what amount of income has been distributed to them, and then they would need to include that in their tax returns.
Thanks, Kim. Okay, I think we have one more. If you make an interim distribution that is 100% capital, does that affect the present entitlement?
So it's going to come down to what kind of gift that was. So where you've got specific gifts and legacy gifts, it doesn't affect present entitlement. It's where you've got the residue of the estate is known. So if you're only distributing capital under the estate because they're residue beneficiaries, you're probably at the point where they are presently entitled. But if they're specific gifts, you might not be at that point yet. So no, it doesn't affect it, but it probably does give you a key indication of where you are in the estate administration process.
All right, thanks, Kim. I note that we have had a question from Walter, but it does look like some of the question has been cut off and we might need to give that one a bit more consideration. So we'll probably come back to you on that one separately, Walter. But I think that's all the questions we have for the time being. So thank you everyone for attending today. As I mentioned at the start, there will be a feedback email circulated later today. And we really do take your feedback and your comments on board. We're particularly interested in learning what topics you might be keen on hearing about in the future. We will be putting on another webinar probably at the end of April. We haven't yet confirmed the date or the topic of that webinar. So if there is anything you would like to hear about, feel free to include that in the feedback email. But otherwise, thank you very much, Kim, for presenting today. And we hope to see you at the next webinar and hope you have a great afternoon.